Hello, everybody. I'm Jeina Garvin. Nice to meet you. I wanted to get a little first-time homebuyer course out for everybody. I am a home mortgage lender at American Liberty Mortgage. And so I thought this would be helpful. I get a lot of first-time home buyers or people who haven't bought a home in a long time. And, the market's kind of changed that I thought I could just put together a quick little presentation over a general review of kind of what it takes to buy a home and what you need to know. And of course, if you have any other questions, feel free to reach out to me. Any specific scenarios, I would be more than happy to kind of review those with you and get you more information. So we'll get started here. Just a little bit about me. I'm a mortgage lender in Scottsdale. Kind of went over that. I have been in mortgages since 2011. I started my career at Chase Bank. I was a loan processor when I started in mortgages. And then after that, I moved into underwriting for about 3 or 4 years. And then I had my first daughter in 2016 and decided to move into sales because it was a little bit more flexible of a schedule. And I was in that position for almost 3 years. And then, COVID, and I took 2020 off to raise the 2 girls. And then I started back up at the beginning of this year with a brokerage. So super excited to be kind of at a new company in kind of the same position, but a little bit different, and back helping people buying homes again. Because of all of the background I have as a processor and an underwriter, and also in sales, it helps me to kind of collect all the documents up front. I can predict a lot of what underwriting is going to be looking at. So I just collect everything up front during the application process. And I have been able to have super smooth transactions with people getting to closing very quickly, which is great. And not a lot of surprises along the way, but it's mortgage. So there's always surprises to be had. Tim Garvin is my husband. So we have 2 fun and beautiful little girls. They are 1 and 4. They are keeping us on our toes and very, very tired, but they're adorable. So that's the good news. I love my job as a mortgage advisor. I love finance. I love real estate. I love helping people achieve their home and financial goals. And I love getting to know others and looking forward to kind of getting to know everybody that works with my husband and probably knows my husband, and maybe we haven't met before. So looking forward to getting to know a lot of you a little bit better. Let's see. So I did just like a quick little 6-step thing on kind of a general view of what the home buying process looks like from start to finish, where to start, and then kind of where it ends. So first, you would talk with a mortgage professional, which would be me, and we can have you fill out an application, get you pre-qualified, in which case you would then hire a full-time realtor. I recommend using a full-time realtor. This market is extremely competitive. I think it's very important to have somebody who is devoting 100% of their working time into the real estate market and not having other obligations of another career that may be in the way of you being super competitive with your offers. I mean, homes are selling the day they're going on the market. It's pretty wild. So I do recommend a full-time realtor. I always say keep saving and working on your credit while you're shopping for homes, while you're out there, even while you're thinking about buying a home, maybe haven't even started the process, but know you want to buy a home in the next couple of years. You always want to just keep saving and keep working on your credit, which I'm going to go into a little bit in a few slides about how you can be managing your credit while you're thinking of home ownership on the horizon. And then just be patient. The market is wild right now. So, it might take a little bit to find the right home, and that's okay. And so just knowing that and not getting discouraged is really important. So what are lenders looking for? They are looking at credit, income, and assets. A little bit. All right. So what makes up your credit score? This is just kind of a breakdown. We all kind of check our scores, but I don't know if everybody has a good grasp of what exactly is causing your scores to go up and down. It can be confusing, and it doesn't always make sense. So this is kind of just a little breakdown of what are the big things that affect your credit and then smaller things. So you can just be kind of managing that on your own as you're trying to prepare yourself for home ownership now or in the future. The biggest category would be your payment history. So that makes up about 35% of the score. And they're looking for, do you pay your bills on time? This is the best way to maintain and improve your credit score. If you are missing any payments, get them current and stay current. That is the best thing you can do to keep your score up. If you have missed payments, like I said, it's okay. Just get them current and stay current. And every month that you're staying current is moving you closer and closer to a better and better credit score, which will affect your rate and ultimately your monthly payment. So having a good credit score is very helpful. And it can also affect if you're getting into an FHA or conventional, which we'll go into that later as well. Amounts owed, that's about 30% of your score. So how much debt do you have? Lenders don't want to see a high credit card balances or too much of your income going to debt payments. So one thing that I like to advise my clients to do to keep their debt to income ratios in line, or debt to available credits in line, is to call all of your credit card companies, ask for a credit line increase. Now, we don't want to use that extra credit if they give it to you. And you can call them I would say call them every month or two, see how often they can improve your credit. So say you have a credit card balance of $500 and your limit's $1,000. That's 50. You're using 50% of your available credit. To keep your credit score the best, you want to keep those ratios around 10%. So if maybe you can't get that paid down right now, you can ask for a credit line increase and say now they move your credit line up to $2,000. Now you're at a 25% instead of a 50% ratio of usable credit. So really paying down, if paying down debts isn't an option, or even if it is, you also want to be boosting the amount of credit available so they can see, hey, this person is really responsible. They have a lot of credit available, they're paying their payments on time, and they're not using all of the credit that's available to them. Number 3, about 15% of your score is length of credit history. The longer the credit history, the better. So, young people have a little disadvantage at this. I know a lot of people I talk to that have been working on their credit before talking to me, and they're like, yeah, I have this credit card from college. I racked up a high balance. I almost have it paid off, and then I'm going to close it. And I'm like, no, don't close that account. That is your best account, your oldest account, that one you opened, in college under your parents, whatever. That is your longest standing account. You want to keep that account open. It's good to pay it off, pay it down, but don't close it. Even if you pay it to a 0 balance, you want to hold that account open because it's helping your average credit length be longer. And then number 4, we don't want to try to not open new credit. So 10% of your score is, have you opened or applied for a new account recently? Opening too many new accounts in a short time can hurt your score. It's only 10%, but it does bring it down. And it leads into that average length of credit history too, because your new credit is less than a year old or a year old. That's going to bring down the average length of credit down. So kind of intermixes with number 3 there. And then number 5 is your credit mix. That's about 10% of the score is, they want to see that you have a good record of managing a mix of credit. So student loans, car loans, credit cards, etc. That will improve your score. So credit, how we do credit, pull credit, our company will pull a tri-merged credit report. It's from 3 credit reporting agencies, Equifax, Experian, and TransUnion. We pull a report specifically for mortgage lending. So we're not using the same credit report that, Free Credit Report or Credit Karma is using. I think using those companies to kind of check on your score and manage if it's what things are bringing it up and down is good to get a baseline, but usually the score they're pulling is not going to be the score that we're going to pull in mortgage lending. And then once we pull that, we'll get the 3 scores. Like I said, we use the middle of those 3 scores. If there's 2 borrowers on the loan, we would use the lower middle score of the 2 borrowers. And sometimes, you know, we can always look at that. If one person wants to be on title but not on the loan, there can be advantages to that. That's something that we would discuss after I took your application and looked at the whole picture, if I thought we could do any strategies like that. Derogatory credit or late payments, those can show up on your credit. That would be something, you know, that we'll look at. It doesn't disqualify you necessarily from getting a loan. It could hurt your score. That would be something that I would review as part of the loan application as well. Sorry, I got a little typo here. And then, I don't know what I was trying to do there. And then the other cool thing at my company, this little credit repair section that we have here, that we did not offer this at Chase, and I'm so excited to be able to have a tool like this at the company I work for. It's a credit repair tool. So after I take your application, we pull your credit report, tells me your credit score. We have a little tool that tells me how much we can improve your score immediately. We can do long-term calculators as well, but the immediate rapid rescore is a really great tool for people who want to buy right now. And I've been able to improve people's scores quite a bit, allowing them to go from being able to only qualify for a FHA loan with their current score to now being able to get conventional, or if they're already in the conventional, to bump their score up enough to get them to that next tier of rates, which your interest rate affects your payment. The higher your interest rate, the higher mortgage payment on the same purchase price. So being able to have the best credit score possible allows you to pay lower monthly payments. All right, and then income. Primarily, lenders are looking for stability when we're calculating the income. We typically want to see a 2-year history. Large increases or decreases over a 2-year time frame. We may average those, maybe not be able to use them. It just all depends on the situation. It's another thing, you know, why we recommend taking an application so we can look at the bigger picture. And then for anything like this with large increases or decreases, gaps in employment, we would just usually get an explanation with that to figure out how we would calculate that income and if it would prevent you from being able to use that income at all. Job changes within the same profession are okay. If you have recently graduated, your education can qualify as work history. So maybe you haven't been working 2 years, but you've been a student, we can definitely use that to still get you qualified. And of course, everything will require underwriting approval. Exceptions may be made. Other loan factors can affect approval. So this is not an offer for credit or approval. Your debt to income ratio might be something you hear along in the loan process. And we'll go over this later when I go over loan programs about what debt to income ratios we can go to. But for a conventional loan, we usually want to stay around 45% debts to income. And what is included in your debts ratio is mortgage payments, taxes, insurance, auto payments, student loans, credit card payments, timeshare payments, personal installment loans, child support, alimony, and any co-signed loans. What we will not include in the debt to income ratio: utilities, car insurance, your cable bill, cell phone, health insurance, your current rent or mortgage payments, if you're going to be selling or moving out of that situation. If you're going to, for some reason, be keeping that, then that's a different story. But the current home that you're leaving, exiting the payment, wouldn't be used. And charitable contributions, I'm trying to think, like gym memberships, you know, your Netflix subscription, anything like that is not going to be included in that ratio as a debt. Assets. So what can we use as assets? We can use checkings and savings accounts. We can use gift money from a family member. If you have any mutual funds, If you have any sales of a big asset, like you sold a car recently, or you know, a piece of jewelry, something with a lot of value, we would need to collect documentation, but we can use those sales. Any retirement accounts, even if you're not planning on liquidating a 401k or something, that can still help you to get qualified for a home mortgage. Or you know, always can use that if some people choose to liquidate and use that towards their down payment and closing costs. And you can also use equity from the sale of a home. So if you're selling a home to buy another home, we can always use the equity from that home for the new purchase. So then we'll go into the types of loans. There's FHA, VA, conventional, jumbo. So we'll start with FHA. FHA loans are a government loan to help people with lower credit still be able to get into the home buying, or to be able to buy a home. So they do charge a fee for the program of 1.75% of the loan amount. This is added onto the loan as an upfront mortgage insurance premium, which mortgage insurance is something that you will pay on your loan, whether it's conventional or FHA, if you put less than 20% down, and they just have an additional upfront mortgage insurance as well, just to say, hey, we're, you know, kind of taking a chance on the lower credit to still lend you money, but we're going to put this into a pool for anybody who's defaulting. They can back those accounts to make sure that the lender are still going to get paid. You can do as little as 3.5% down on an FHA mortgage. Your mortgage insurance, so you have the upfront mortgage insurance on the FHA, and then you also have the monthly mortgage insurance if you're putting down less than 20%. And on an FHA loan, that monthly mortgage insurance will not drop off. So that will be on there for the life of the loan or until you refinance out of that product. Once your home value is at 80%, you could refinance out of the mortgage insurance. The FHA has less restrictive guidelines, which is really great. You're allowed to do a higher debt to income ratio with the FHA loans. So helps people with lower income be able to afford more expensive home than they possibly would under a conventional loan. And the max loan amount on the FHA loans is $368,000. So you cannot do a loan more than $368,000 and stay in the FHA. You would have to move to conventional. VA is our veterans loan. Again, this is a great program for any veterans. They do charge a 1.75% funding fee as in addition as a cost of the loan. But the really great part of this program is they allow as low as 0% down. So you can get into a VA loan if you're eligible for as low as 0% down. Conventional loans, these are kind of the bread and butter of loans. These are the loans that we would sell to Fannie Mae and Freddie Mac, if you've heard of those. So we will take your loan application, service your loan. We do sell the conventional loans to the Fannie Mae or Freddie Mac, and then we will continue to service the loan though. We do have conventional loan programs where you can get as low as 3% down payment, which is awesome. You do have to qualify for that program, and otherwise you can go as low as 5% down if you don't qualify for the 3% down payment. Your mortgage insurance will drop off automatically when you reach 78% of loan to value based on your purchase price. Or again, you can refinance out of the mortgage insurance as well if home values go up faster than you're paying down the mortgage. There is a credit minimum to be able to qualify for conventional. So when we were talking about credit repair and working on your credit risk score, why it is so great to be thinking about that in advance, even if you're 1 or 2 years away from buying a house, is so that you can hopefully qualify for conventional loans If you don't meet the credit minimum for conventional, then you could qualify for the FHA. Again, there is the FHA funding fee, and 3.5% is the lowest down payment for FHA, which I know that 3% is a little bit less and more attractive. And also conventional allows you to go to a maximum loan of $548,250. So a little bit more flexibility there. And then in this market too, it is when you're putting offers in on homes, and this is something you'll talk about with a real estate agent, it is more competitive to be able to submit a conventional offer versus an FHA offer when you're submitting your offers on homes. So it's good to have a good credit score for many reasons, which is why I love that I can help you repair your score. And then we do have the Home Possible Home Ready programs. Those are the ones that allow you to get the 3% down payment. And they sometimes have a little bit discounted rates as well for clients who meet the requirements. And then there's jumbo loans. They're just for any loans over $548,250, you would not be able to do conventional anymore. You would be in a jumbo loan category now. You're required to do a 20% down payment. You can do up to 10% down, but the interest rates get really high, so and very hard to qualify for. So typically, you'll want to be able to put 20% down on any jumbo loans. And I'd be happy to go over more information on those. I didn't do a lot of information here. If anybody was interested, just reach out. So moving on, what documents will I need for pre-approval? So income verification documents would be, some of this will be collected in the application too, and some of these will be documents. So names and addresses of employers for 2 years, that's something we would collect in the application. And then documents we would collect, we'll have 2 years of W-2s, 2 years on your tax returns, your most recent year-to-date pay stub reflecting at least 30 days of income. So if you're paid twice a month, we'll get 2 pay stubs. If you're paid every week, we'd get 4 pay stubs, etc. If you're self-employed, you know, this could be for a spouse or whatever, anybody else who's going to be on the loan, or if you have a side job that's you're self-employed, you wanted to use some of that income to qualify, we would need a year-to-date profit and loss statement and 2 years of business returns. If you're using, if anybody on the loan is using pension income, we would need that documentation. Social Security or disability payments, we'll get documentation for that if you're using that income. Any dividend earnings. For bonuses, we would get, if you get commission or bonus income, we would collect your last 2 years end of year pay stub to help us figure out what your bonus average is over 2 years. Any child support that you're receiving, we would get documentation of that. If that's something that applies to you, we'll chat one-on-one on what exactly would be needed for that. And then same with alimony or separation maintenance payments. For your asset verification, we would get 2 months of bank statements and a copy of the earnest money deposit check once you were to get into contract on a home. And then debt verification, we do pull your credit report, which covers most of the debt verification. If you have any new debts or anything, it's possible we may need to collect your most recent statement on any of those accounts. And then what would be your next steps? I hope that was kind of like a good overview of what it takes, kind of, if you're thinking about buying a home. Like I said, now, next year, a couple years from now, I hope that gives you a few things to think about that you can be working on now or applying to get you ready for buying a home. If you have any questions, please let me know. I'm hoping to do more of these videos for you guys. So if you want to give me feedback, send it to Pat or send it, to me directly about what you'd like me to go into more detail on, maybe something I didn't clarify very well. This is the first video I've done like this, so I apologize if it's a little, I don't know, not as professional as maybe somebody else's, but you know, I'm happy to tailor it to whatever is meaningful to you guys, whatever you guys want to see. So please reach out to me and let me know anything specific you would like me to cover in my next video, and I can kind of deep dive on different areas and hopefully get out more informative videos like this for you guys. If you are ready to buy a home or want to see if you're ready to buy a home, go ahead and fill out an application. My link is here. It's just jeinagarvin.flowify.com/apply, and I will have Pat put it in the email when she sends out this video, so you can apply if you want, or give me a call. We can talk about where you're at, where you want to be, just kind of a general conversation, and see if I think now is a good time to apply. So however you prefer, chatting with me first or just going ahead and apply. And if I do get your application, I would definitely reach out once I receive it and kind of have a little conversation with you about what you're looking to do. And then I could get you a pre-approval. I can get people pre-approved pretty quickly. Once the application takes about 10 minutes, and then I'll just collect all those docs like the pay stubs, W-2s, tax returns, bank statements, like I was talking about in the other slide. And once I get that, you know, it takes me less than an hour usually to review all that, sometimes faster, just depends what's going on with your situation. And I can get out pre-approvals pretty quickly if needed. And then once you have the pre-approval, you can start talking with the realtor and looking at properties in your price range. So let me know, again, if there's any other questions. I would love to get to know you guys and help you with your home purchase or just getting you ready for buying a home in the future. Oh, and then here's my question slide. So this has all my contact information. This little square here is just a little link if you want to scan it. That's for people who already own a home. They can sign up for, find out what your home's worth, and it has a bunch of homeowner tools to see what kind of equity is a refinance right for you, stuff like that. So yeah, that's all my contact information. Again, feel free to email me, call me if you have any questions, and I look forward to hopefully hearing from some of you soon. Thank you so much for listening. And like I said, I've never done a presentation like this before, so I hope it was okay, and I am open to feedback. Have a good day, and we'll chat soon. Bye-bye.